everyone, welcome to the next installment of Charts and Perspective, where we use charts to dive into the world of economics and financial markets. I'm Jennifer Nash, an economic and market research analyst for Vetify. Today, we're going to look at the 10-year Treasury yield. We'll examine its historical trends over the past 60 years and explore its relationship with key economic indicators like the Fed funds rate, inflation, and the S&P 500. But first, I want to take a moment to talk to you about Exchange. Exchange is a financial services conference for advisors to strengthen their skills and develop across core dimensions of their professional portfolio. I hope you stay tuned after the video to learn more about this exciting conference. Now, back to the 10-year note. First, let's look at the 10-year yield and its relationship with inflation and the Fed funds rate. Note that our chart shows the 10-year yield's weekly average, not daily closes. Still, as you can see, it has experienced dramatic fluctuations. The stagflation crisis of the late 70s and early 80s demanded drastic measures. Under the leadership of Paul Volcker, the Federal Reserve pushed the FFR to a historic high of 20.06 in January 1981. 9 months later, the 10-year yield's weekly average hit a peak of 15.68% in October. This aggressive tightening of monetary policy was instrumental in curbing runaway inflation, albeit at the cost of a significant economic slowdown. In stark contrast, the FFR was driven to near zero levels in the aftermath of the 2008 financial crisis, and again during the economic turmoil of the 2020 pandemic. Specifically, the Fed funds rate reached a record low of approximately 0.04% in May 2020. A few months later, the 10-year yield weekly average fell to a historic low of 0.55% in August. These periods of ultra-low interest rates aim to stimulate borrowing, investment, and economic recovery. What happened next was inflation reached its highest levels since the stagflation crisis I just mentioned. In response, the Fed raised rates to fight inflation. Some would argue their efforts were a little too late. From May 2022 to August 2023, the Fed quickly raised the Fed funds rate to its highest level in over 20 years. Meanwhile, the 10-year yield moved in similar fashion. The Fed held its rate steady for just over a year as inflation cooled from its 2022 peak. In September of last year, they began their rate-cutting cycle. However, interestingly, while the FFR declined during the back end of 2024, the 10-year yield moved in the opposite direction. At the same time, inflation proved sticky, and many continue to worry that it has stalled out above the Fed's 2% target. At the end of February, the 10-year yield weekly average stood at 4.31%, its lowest level in over 2 months, while inflation was at 3.0%, its highest level in 8 months. The Fed is expected to continue cutting rates this year, with the market currently pricing 3 cuts in 2025, starting at the June meeting. Now let's look at the historical pattern of equities versus treasuries. In our next chart, I've overlaid the S&P 500 with the 10-year yield's weekly average in the Fed funds rate. Generally, equities and treasuries tend to move in opposite directions. When one goes up, the other goes down. However, that's not always the case. During inflationary periods, like the past few years, both move in tandem due to the impact of higher interest rates on corporate profits and bond prices. This chart presents nominal values, meaning it doesn't account for inflation, which can create a misleading picture of the actual purchasing power of yields and equity returns. Here's the same chart, but this time the S&P 500 and the 10-year yields are adjusted for inflation using the Consumer Price Index. By adjusting the data for inflation, we gain a clearer understanding of the real returns. This adjustment reveals the severe impact of stagflation, particularly the significant decline in real equity values from the mid-1960s to 1982. We can also see why high yields can be deceptive in periods of elevated inflation, as evidenced by the stagflation from the 70s and 80s, and more recently from just a few years ago. The Fed fund rate line offers valuable insight into the Federal Reserve's monetary policy. We can see how the Fed has used rates to control inflation, accelerate growth, and when needed, apply the brakes. I've annotated the chart with the 10 years of the Fed chairman so we can see who is managing the various FFR cycles since 1960. Examine the FFR's historical extremes, from the 20.06% peak in 1981 to the 0.04% trough in 2020, underscores the Federal Reserve's capacity to implement dramatic policy shifts in response to prevailing economic conditions. In the early 1980s, the priority was taming inflation, while in the aftermath of the Great Financial Crisis, the focus shifted to preventing deflation and promoting economic growth. It's not obvious that the Fed has done a great job stimulating the economy. However, even during periods of high interest rates, such as the late 1980s and the recent period of rates being at a 20-year high, the S&P 500 has demonstrated resilience and achieved record highs. Thank you for tuning in. For more economic and market insights, you can find my content regularly on the Advisor Perspectives website under the AP Charts section.
Stuck in the same patterns and routines? Trying to take your practice to the next level? You need to register for the Exchange Conference. In March 2025, industry experts will be gathering in Las Vegas to share actionable information, network, and learn the latest innovations in practice management. Invest in your greatest asset, yourself, by registering at exchangeetf.com today.